U.S. banking regulators have confronted an unusually large penalty when they seized Silicon Valley Bank last year, and that's $285 million in fees to prematurely wind down emergency financing from the federal home loan banking system. We're going to discuss this with Bloomberg's Sally Bakewell. First of all, Sally, why was this fee so large?
Okay, so when Silicon Valley Bank was teetering on the brink of collapse last year, it borrowed money from the federal home loan banking system. Now, this is a system that was set up in the Depression era to lend to housing, basically, but it's morphed a lot beyond that initial mandate, and now you can probably get a loan for just about any purpose. Now, Silicon Valley Bank had borrowed about $30 billion at that time, and when regulators took it over, they opted, instead of keeping that loan outstanding, to pay it back early, which unfortunately meant they had to stomach this $285 million fee. But of course, it reduces their borrowing costs in the longer term and frees up collateral. But anyway, that's how we have this fee, which also ultimately goes into the bottom line of the Federal Home Loan Bank, which was able to post a profit.
Well, that's my big question here, too. Should the FHLB be posting a profit off of essentially the demise of another bank?
Right. That question feeds into this broader debate over this system at the moment. It's a hot topic in Washington and became so, particularly, it was really amplified after the regional banking turmoil last year, because it was not just the Silicon Valley Bank that it was propping up, but it was also Signature Bank, sort of known crypto lender, and First Republic, known wealthy clients lender, which you'll note don't really fall into the mandate of home lending. So that has really amplified criticism and sort of concern about the system and to whether it's moved too far beyond its mandate and shouldn't really be there propping up sort of ailing lenders, which ultimately may cost more.
Really quickly here, in 30 seconds or so, how is this likely to drum up even a bigger debate in Washington when you see the sticker shock of $285 million here?
Right. It raises the question about should this system be supporting ailing lenders and should it, make a profit from doing so? And the regulators of the system in November unveiled some reforms that would perhaps bring it back to its original mandate by, for example, ensuring that members have to have about 10% of their assets in mortgage loans, and also maybe curtailing some of the salaries of the executives at the system.